All right, we are about 30 seconds away from getting things started. Sierra, great point. It definitely does have the wrong date, so I'm going to try to update that really quickly before we get started. Okay, there we go. We should have the title updated. We have hit the end of our timer, even though I'm pretty sure it got hidden from the screen at one point. There it is. We're going to X out of that. But we are ready to go. We are locked in. Welcome back to our weekly stock market option selling trade analysis. And once again, I think I probably should come up with an official title for this, but that's what we've got right now. For those of you who are joining us, again, thank you. For those of you who are new, I hope we don't put you to sleep over the next hour or so, and hopefully we can all come up with some really good ideas together for the upcoming week in the market. Now, if I were better at Twitch and streaming, I think this is the part where I would use some audio sound effects to play some really sad music as we do our weekly recap, because we lost about $3,500 in the market last week, which obviously we never want to lose money in the market, but it's always important to keep perspective. So there are two main things I want to point out in spite of the losing week. The first is that the overall market returned minus 2.19%. Our loss was only minus 2.13%. So we outperformed the S&P 500 slightly. So, that's what we're going for. We've accomplished our goal. While it's a little bit bittersweet because we didn't actually make money, our single greatest goal is to outperform the market, and that's what we did this week, and that's what we've done for the past several weeks. So we're happy that we've been able to keep that one up. And then the second thing is that even though we did lose money, if we pop over to our year-to-date summary tab, you'll see that overall in September we still made about $5,600. We had a 3.64% return on the month, and while that's not a super big home run number, right? We see some bigger numbers for August, the month prior especially, and some of these a little earlier on in the year. The one big thing that is different about this month was September, and you can see the slide right here in the chart where we compare our performance to the S&P 500. September was the worst month for the S&P 500 since the COVID crash. And the fact that we were still able to make money in that month, I think, is a really solid testament to our strategy. But importantly, where did we go wrong? And I could really point to three separate trades that we had. First being SPIR, second being LIDR, and then the third being, a week ago with TMC. Between the three of those, if we highlight that, we scroll down here, we highlight SPIR, and then we also highlight LIDR. The three of those trades lost us just over $9,000. And that would have put us at a really tidy $14,000 return in September had we not made those trades. But, we did. That's the reality of trading. You're not going to win every single trade. And I think it's more important sometimes to talk about the losers instead of the winners. Quick shout out to Hyper, Z, Jules, S. Kotha, all the people in the Twitch chat checking in. Neverender223, we got Sierra. Appreciate you guys joining us and being active in the chat. But, to that point, we kind of fell for a little bit of these former SPAC plays. And the issue with that, and I guess the important thing that I want to highlight here is, one, to identify the reason why things went wrong, right? So it's pretty obvious just in this past week alone, SPIR and LIDR, we lost about $7,000 from those. That would have taken us to an overwhelmingly green week. So, the core strategy is doing well. We're going to try not to get away too far from that. Because what we're doing is working. We just had a couple, disasters, so to speak. And anytime you could have a disaster and still outperform, I think that's still a win for us. But importantly, what are we going to do to make that different? And we had that very relevant question from John Michael in the Twitch chat saying, were they wrong trades or just trades using the strategies we employed that happened to go against us? And short answer to that is, all three of these trades had a very similar mechanism that caused them to go against us. So what happened with these, we saw that these were deep out of the money puts, right? LIDR was trading at about 9 or 10 bucks a share. SPIR was trading about 15 or 16 bucks a share. TMC was near 10 or 11 bucks a share when we got in on that one. Yet they all had premium on these deep out of the money puts. And normally when we see something like that, we like to put into play our little IV reversion type strategy where we sell something deep out of the money on a stock where implied volatility is sky high. Implied volatility is something that normally inevitably comes spiraling back down to earth, and then we collect the premium from that. And that works for the most part, because if we go to our strategy summary here, we have a 36-2 record on these IV reversion trades, and admittedly that's without factoring in the last three that I just talked about, so it's going to be 36-5, but still a really, really nice win rate overall. So I think the strategy behind that IV reversion type idea when we enter into a trade is still going to be relatively sound. The issue with these is that they were former SPACs, and what happened with these former SPACs is the unlocking and registration of the PIPE shares. And what that means is there are these investors that kind of get in super, super early when it comes to funding a SPAC. They have these really large chunks of shares that they hold, typically below market value when a certain filing, I think it's called a B242, 424, I might be getting that number mixed up, but to that point, they basically have this filing that they release that registers all of these locked up shares so that they can be traded on the market. And what happens is a lot of these big institutions that are holding a lot of these shares, the first chance that they get rid of them, they dump those shares. So that is what happened on TMC. That's what happened on SPIR. That's what happened on LIDR. And that is really the one big mechanism that made all these trades turn against us. So what have we learned from this? One is that I'm really going to be hesitant to chase something deep out of the money if it's a former SPAC. The second, and I think more interestingly, because this is something that presents an opportunity that we could take advantage of in the future, is, how can we use this information to trade in the future? And we got NASCAR Al out in the YouTube chat saying, just got in, can you explain TMC again? We'll loop back around to that in a sec, but to kind of close the point that I was bringing up, let's take a look at SPIR. Because we got in on this one, if we take it about the 20-day chart here, we got in when this thing was trading around 15, 16 bucks a share. So the fact that we were able to sell 7.5 strike puts in November, we were saying, this is unbelievable. And if we take a look at this chart, evaluating the chart as it looked the day that we would have entered into the trade, we could have backed up and said, okay, we have all this way down right here that we have protection against. What's the catch? We figured it was just because it was spiking up towards 20. Implied volatility was spiking. We figured that was just pumping premium into these options. So we jumped in on that trade, and eventually, for those of you who have been following, it dropped off severely. But light at the end of the tunnel here is that as terribly as SPIR went for us, our break even is like 690 on the trade. So as long as it hangs tight at this 7-ish strike or a 7-ish price, we're going to make money overall despite the enormous drop. But getting to the point, the opportunity, the more interesting part for you guys is how we're going to make money off something like this. Buying puts for the lockup date, which, if we knew when the lockup date was coming, that would be a home run, right? But what's interesting about these is you never know when the lockup date is actually going to happen. So what happens is the market closes, they submit the filing, that goes public, and then the shares can be dumped. And that's what you see with this big red candle right here at about 4:30 on September 30th, which was Thursday afternoon. They had that filing that unlocked all of those shares. The shares subsequently got dumped and dumped even further at market open. So buying puts really isn't going to be the greatest idea because you don't know when it's coming, and you sacrifice a lot of the value by just waiting. What I propose is waiting until they file that registration statement, those shares get effective, and then you see the dump. If we zoom in here to the 5-day, 5-minute chart, there's typically a really good opportunity at about 10:30 the morning after the dump, and Fendomania is getting a little bit ahead of us here. I might as well have him jump on and lead the stream because I think we definitely talked about this one a little bit in the Discord server, but right around 10:30, you see a decent jump right here. And what we were able to do at 10:30 is we actually added to our position on SPIR. We sold some 6 strike puts for 30 cents a piece, and these things, admittedly, we jumped in too early. We got in up at around the 8 level. If we waited even further, these 6 strike puts were going for about 50 cents a piece at the peak. So we were a little bit impatient there because, admittedly, I was kind of panicking a little bit on the way down. I knew my price was going to be okay, but it was one of those things where the 6 strike puts looked like such a good value. Looking back on that, I should have waited a little bit longer, been a little bit more patient, and then jumped in on that. But back to the point we're getting into, waiting until about 10:30 the morning after, I think is kind of the sweet spot for jumping in on those 6 strike puts, or whatever stock you're looking at, a strike lower on the put side of things. And we could take a look at something like VLTA, which is going to be a really similar example, right? They had this, it was a former SPAC trading above net asset value even at about 11 a share. And then on September 29th, they filed that, and all of a sudden they had this big overnight sell-off. And right at about 10:30 in the morning, look what you can see. And shout out to Michael. I can't read the last part of that because my preview on my laptop is super small, but appreciate the follow. But again, you see this on VLTA. You have the pipe lockup expiry. All of these shares are released into the market, and right around 10:30 in the morning, you see this increase right here. We have a question saying, am I the TikTok guy? I have a TikTok channel. I don't know if I'm the TikTok guy, but I guess that's for you to decide. But again, point being, we just looked at SPIR. We're at 10:30 the morning after. You see a really nice, rebound off of those lows. SPIR, we saw a rebound off of those lows at 10:30. While not as significant of a rebound as VLTA, I will say the VLTA rebound did take another day or so before it really started running back up. But this is what we like to see. We have a question about, what's a SPAC? A SPAC is a special purpose acquisition company. You can identify them pretty easily. There are these charts where they've been hanging out at about $10 a share forever because they're a holding company that's full of cash. They use that cash to acquire a company that wants to go public. They essentially undergo what's called a reverse merger. So the SPAC acquires a piece of that company. They start trading under the publicly traded SPAC, and it's kind of a roundabout way to avoid an IPO and take a company public. But that's what a SPAC is. That's what happens. But with that kind of transaction, there's all these hidden little, intricacies for these investors and all these little complexities with the way that they're structured as far as share ownership and things like this. And these pipe lockups are just another thing that make it even tougher to digest. So the I don't think I'm the guy yet, you guys. We've got 20 people watching me live right now. I think I'm pretty far away from that. I think I could go outside and round up more people. But point being, 10:30 a.m. is something that we see. We like to see that rebound. And another one coming up, FFIE. They're kind of in the window of a company where they're probably going to be filing that registration statement soon. So we're going to have our eyes on this one in case we see another similar overnight sell-off. So that's where we're at with these. Obviously, it sucks to lose money on that, but light at the end of the tunnel. There's always a little bit of a silver lining, is that even when things go bad for us, and believe me, these went really, really terribly, things are still all right. We still outperformed the market on the week. Taking a step back, we still made money the month of September. We haven't lost money a single month on the year yet so far in 2021. So as bad as things went last week, things are still okay. It's going to be all right. That's just the reality of trading. And now I would love nothing more than to pretend like this never happened. But being transparent about our losses is something that's really, really important, because that's the reality of trading. And if we put forth only our wins and gave people this unrealistic vision and expectation about what option selling is and what actual long-term investing looks like, that would just be a little bit dishonest. And having these expectations, knowing that a week like this is going to happen to you every now and then, but just trusting the process, knowing that in general, you're going to be making money in the long term. You may not kill it one week, and in fact, it may take a whole month for us to make this 1 month back. But at the end of the day, look, we're still at an 87.8% return on the year. We are still very, very happy with where we're sitting on the year. And most importantly, it's super easy to make money when the market goes up. What's really important, what you should look around and evaluate, is what's going on when the market's pulling back, which is what we're seeing here. And in the month of September, we still made money. Whereas a lot of the people in the last 18 months, while the market has basically taken a straight line up, so to speak, it's pretty easy to just buy calls and blindly make money. it's pretty much just like shooting fish in a barrel. But what's really important is if your strategy can handle these pullbacks. And I think we demonstrated that we really can, because outside of just a couple mistakes, and these mistakes really are outside of what's going on in the overall market. These were just a strange situation with former SPACs, because if you look at the rest of the trades we made this week, right, we're very, very profitable on those. So what do you do when you take a dump? When you take a number two, you don't sit there and stare at it. You flush it down and you keep moving. So that's what we're going to do. I mean, quick rundown from top to bottom. CRSP, that was one that we thought was a little bit safer of a trade. That one worked out for us. DraftKings worked out. SOL. CLOV is one I want to talk about quickly because where'd it go? We sold the 7.5 strike put, and on Monday we were able to close these out for over 50% of max profit. You might say, hey, with CLOV, and I'm going to have a little bit of a spoiler here, we pull the chart up, but on Monday, which was, what was Monday? Monday was the 27th, right? So on the 27th, if we pull up the 20-day chart and cut it off to show what we were looking at here, right, you would have seen that we had a 7.5 strike put where, the limits down here was trading at 8. You might say, okay, it would have been really easy for us to hold on to this and make an additional, what would have been, let's see, another $90 on that if it just stayed above 8. But the important thing to keep in the back of your mind is that on Monday, there is still so much time between Monday and Friday that we really want to take advantage of profit when we see it, especially when we're able to take over 50% of max profit that early on. So point being here is the fact that we sold these 7.5 strike puts, we took the profit, and we're definitely glad that we did, because if you keep scrolling forward here, it dropped well below this line and put us in a position where we would have been losing money at one point on Friday. So we went from, we avoided being stubborn. We took the profit. We took the money off the table. Once that thing's closed out, they can't take that money from you no matter how far the market falls. I mean, your next trade might lose money, but if you keep collecting these base hits, eventually you're going to be scoring a lot of runs with the strategy that we have. So that was one that I was happy we did that with. DraftKings was another one, because that similarly was pushing up against that strike that we had. So we had to be pretty careful. CRSP, we could take a look at that one really quickly, because I think that was interesting how it played out. We sold the 110 strike puts, CRSP. And another one where I think it's pretty helpful to progress and scroll through this as we progress through the week. So the 27th, this is going to be Monday. We sold a 110 strike put. We know, okay, we have a decent amount of cushion right here. And we go to Tuesday, okay, we were starting to lose that cushion, but at the same time, we know that our break-even price was about 109. It's pretty much this red line that we had right here was our break-even price. So here comes Wednesday, and all of a sudden the market continues to drop. We're kind of pushing up against this break-even price. And then Thursday, we get a little bit of a bounce. We think we're going to cruise to max profit. And then unfortunately, on Friday morning, the market drops even more. And at the base of it, the low was 109. So while Friday afternoon, while we would have hit max profit if we had kept holding on, and we would have admittedly made an additional, we would have made $280 more on this. At the end of the day, we just want to make profit on individual trades for each individual week. So while we could have made 280, and in hindsight, yeah, it would have been nice to hold on to that. When it's pushing up against our break-even price like this, we could have gone from a situation where we were profitable to a situation where we were losing money. And that's the worst kind of flip-flop to be having pretty much at the buzzer here on Friday. But keeping in mind that you could take that small profit, and then if you still like the stock, you could do what we did and just play it again next week with the 104 strike for $1.18. And now our break-even price, as we get to wait another week, is right around here. So that's the beauty of, even though we missed out on $280 by potentially getting rid of these a little bit early, we took profit that was available. We moved our break-even price for next week even lower, and now we just hang tight for 5 more days. And if this one just levels out or goes up from here and we don't even have to worry about it bumping up against that break-even price, we're going to walk away with $472, which is well in excess of that $280 that we left on the table last week, so to speak. So that's the idea with that. We always want to be as safe as possible. When you collect profit, right, they can't take that away from you. It's not like unrealized gains. We realize these gains when we close these positions out, and we could just move the goalposts, move the target, move the break-even price lower for the next week. And when you see the market being as shaky, quite frankly, as it has been lately, that's something that you really want to focus on, because it's okay to take a smaller profit or even a small loss for 1 week if in the long run you're doing what we do, where we roll things down, we roll them out to collect similar credits and almost delay that profit a week. I would rather have a week delayed of profit than accidentally fly a little bit too close to the sun and get burned on the day of expiry. So that's the approach that we take. It's a more conservative, but a more, I think it's a smarter approach, and one that is going to help us accomplish our number one goal, which is just to help us protect that capital and live to trade another day. So we have a couple questions that I've kind of been ignoring, because sometimes when I try to read the chat and talk at the same time, I stumble over my words. But let me pull this on the screen so you guys can see what I'm looking at. We had a question: do we set a stop loss on every single trade? And the answer to that is no. We sell cash secured puts. So really, stop loss is to protect you just in case things move against you. If things move against us with our strategy, the HT wheel strategy that we put into play, our recourse is essentially just taking assignment and, like we talked about, moving that break-even price even lower the week after. Now, there is a little bit of a stop loss idea, so to speak, that we use for the other direction, like we did with CLV, where if it's a Monday or a Tuesday and we see that we've realized or can realize more than 50% of max profit on a trade that's expiring that Friday, we'll take it. That's what we did with CLOV. That's what we did with DraftKings. And that's how we are going to keep collecting, like we mentioned earlier, just those smaller profits, which if you start adding up all these sells together, become these bigger profits and can put you in a position where even if you completely shit the bed on a couple trades, you're still going to outperform the market. And if those trades move for you in your direction, like we saw back here on the week of September 13th, you'll put together a really nice week and pull some really nice profits. And that's the goal with what we're going for, right? We're not trying to hit it out of the park. We're not trying to get a 10x return and double our money in a week, but we're just going to keep collecting these small trades where, the returns may be small, but one, they compound into some big numbers. And two, with the way that we've adjusted our strategy over the last few months, the disaster trades that we have really aren't going to set us back too much. And we're still in a position where, if we pull a couple $1,000 a week for the next 2 weeks, we're right back at an all-time high in our account, despite honestly just having 3 horrible trades. These could be some of our worst trades of the year, I think. And to have them all happen at the same time, psychologically kind of sucks, because you could feel like a little bit of a failure despite accomplishing the goal that we're going for every single week. But, in the long run, that is what is going to help us out. Another question: do we sit on our hands after reaching a certain amount of gains during the week to prevent giving back gains? Very good question. And sometimes I do think about it that way. Like, hey, it's Tuesday. We've made $3,000, because on these trades, to be honest with you, they didn't really turn south until Wednesday, Thursday, Friday. We had a really nice gain as of Tuesday of last week, but we're not really trying to hit a quota, right? Because if you think about it, and we had made $2,000 through Tuesday, what's the use in sitting out between Wednesday and Friday, right? Because you could do that, you won't trade for 3 days, but eventually you're going to start trading again, presumably the following Monday. And I feel that the more time we spend in the market, the more money we're going to make. So I'm not of the opinion that I think it's a good idea to just, if you hit a certain profit target, to just completely stop. Because it's not like we're playing with lightning here and the odds are against us and, you're pulling your chips off the table in Vegas, for example. Because in the long run, the odds are in our favor. We're going to keep putting into play these consistent, profitable, and effective strategies. So the more days that we're able to do that, the more money I think we're going to be able to make. So I do think that's a great question, because it is something I think about sometimes, like, man, what if I just stopped and called this week a success? But I think in the interest of doing what's smartest and is going to make us the most money in the long run, we're not going to do that. So I don't really want to stew too much, because we had a bunch of smaller gains. CLV was nice. FFIE turned out well for us. UWMC Rocket Lab has been turning out really nicely for us. That premium is really starting to die off, and that was one trade that we were super excited about. So it's good to see that one coming to fruition, and one that we're going to continue to hold on to. But before we go into what we're looking at for this upcoming week, one quick point on Rocket Lab, because you might say, HT, you just told us all this stuff about how these former SPACs, they're dangerous. They have these pike block ups. Isn't Rocket Lab a former SPAC? And the answer is yes, but with some research that I've done, I've found out that the amount of money being unlocked, or the amount of shares being unlocked for Rocket Lab is far, far, far fewer than it was for TMC, LIDR, and SPIR. So having that huge catastrophic drop off from 16 down to something below 7.5 doesn't seem like it's something that is in the realm of possibility for us. So I was a little bit worried after what happened with SPR, because I definitely thought that was a safer one getting in at 15 or 16. But, you know, we didn't really know a ton about that pipe structure for the share lockup. We know about that now. We're going to avoid that in the future. And I guess that's probably a good time to switch into what we got for next week. And before we make the transition into what we're looking at for the upcoming week, coming up with some new trade ideas, it is the, great time of the stream for some shameless self-promotion. So if you go to hourglass-trader.com, you could join our Discord server, which is, super, super active during the week. We've got a great community. Every single one of our trades that we enter into, every single trade that we close is alerted in our Discord server, and you'll see it up there. We've got the premium chat where someone said something to me. I'm, throwing some shade at Kathy Wood in there. But every single one of our trades, you get tagged, you get alerted to entries, you get alerted to exits. Every now and then we'll throw together some trade plans if something's a little more complex. Like here's our trade plan for Rocket Lab, that trade that we just talked about, where there is a good amount of profit that we're starting to see from that one. But in order to get these, these diamond channels right here, get alerted to every single one of our trades, you could sign up for HT Premium which if you go to our website, you go to join HT Premium. We've got monthly, we've got annual. Annual is a little bit of a discount for monthly. And if you want to do the monthly, you can start a free trial. It's a 1-week free trial, so there's no financial commitment, because what we do isn't necessarily for everyone. But, a lot of people have had a lot of great success, and I think we've got a really good group. So if this is a strategy you're interested in, something you really want to commit some time to and start to learn and execute, I think this is a really great way to add some value to your trading. As you mentioned, all this trade alerts, we got a watch list we use, some blog posts, so you can get the links to the option scanners and this private chat room that we have here. So that is all I'm going to say for that. Also, if you want to get a whole month free, you could sign up using our Webull referral link, which is also in our Discord server. But HT Premium, $25 a month, less than $1 a day for every single one of our alerts. And if you take a look at how we have done so far on the year, I think less than $1 a day spending on that premium package we offer is definitely going to be of good value to you guys. And I hope those who are in it right now have experienced some of that good value. But so that I don't keep droning on and on about this and start to give you some more good value on this stream, let's get into what's going on for the upcoming week. Pulling the chat back up here really quickly. One thing that I got in here that I definitely want to talk about is a question about what do we think about Twitter users like Mr. Zach Morris. And I feel like I could rant about Zach Morris all day. So I'm going to take a quick sip of water before I answer this question. There we go. That is some very nice. I've got one of those Yeti tumblers. I feel like I'm drinking that water that they show in Planet Earth when the grizzly bears are up there in Alaska getting the salmon out of there. I feel like that's the best looking water of all time. And I feel like that's kind of what I was just drinking right there. Excuse me. But to answer this question and not just go on a weird Planet Earth grizzly bear related tangent for you guys, unless that's something you're interested in, just let me know. What do I think about those, fintwitt users, Zach Morris? And first off, to quickly answer that, I think they're terrible. What they do is they get in early on a stock. They buy up a bunch of it. They tweet it out to their 500,000 followers. They all buy it. And then retail kind of gets screwed because as the price of it increases, they keep moving their price targets. And we can actually pull up Zach Morris really quickly here. If I go to Mr. Zach. There we go. The man himself. So if we scroll down here, and he tweets a lot, so it's kind of tough to find everything that we've been looking for. Here, this is kind of rich here. He's saying, "Don't fall for scams." Nice. If we keep going further down, he talks a lot about CEI, and CEI is one. Admittedly, he did call it off the bat when he was getting in at about 50 cents. However, as CEI moved above 50 cents, it's going to be hard for me kind of live here to just keep going through here. So let me just pull the chart of CEI up, explain to you what it was doing as CEI started increasing. So the 20-day chart here is an awesome look. I will give him credit because he alerted this stock at 65 cents. He said, that's when he's loading up. He had a price target of $1 to $2. Now, this is where he kind of frustrates me a little bit, because if you get in at 65, your price target's 1 to 2, you're going to dump at $1 to $2 a share. But that's not where they stop, right? I think these fintwitt guys get super, super, super greedy. They get all these people sucked in. They get these low float stocks that they know if a bunch of retail traders pile into, the price inevitably is going to go up. If we zoom out a little bit further to the 180-day, there really wasn't a ton of volume until this started to get called out by these guys, right? Right around this 65 cent level again, this is where you start to see the volume come in on the stock. So what happens is they say, hey, we have a $2 price target, and then all of a sudden it gets to 1 to 2, and they're like, oh no, we have a $3 price target now, and then it gets to 4, and they're like, oh no, this thing is going to go to 10. And if you are a new investor and you're just innocently looking to purchase stock, you don't really know any better. You go on Twitter, you see that this guy's got 500,000 followers. You're going to say, okay, this guy looks great. He's tweeting out all this stuff about him being rich. He's tweeting out people's profit charts from following him, and this is all just a ton of money, not to mention the fact that TD Ameritrade, you could just deposit money and your chart will look like this, so we don't even know if that's an actual gain itself. But, what are you to think if you're kind of a naive new investor and you don't really know too much about what's going on social media? You see this guy pumping CEI, and I'll post some of these later because it's super, super frustrating. But when he changes his price target from 1 to 2 to 5 to 10, all of a sudden you walk up one day, you log into your broker, you see CEI is trading for about $3 a share or $4 a share, and he's telling you that it's going to be going to $10 a share. And then all of a sudden, before you could blink, you've lost 20% of your investment. So that is why I think these guys are super, super frustrating. With what we alert, we don't pump anything at all. In fact, the price action we depend on is just, hey, I hope this thing stays flat or doesn't completely tank. We're not in here trying to pump stocks 3, 4, 5x, because I think that's super, super dishonest. With the amount of followers they have, it's probably towing the line legally as far as stock pumping and manipulation is concerned. But one of those things where I think eventually what they're doing will catch up to them. It's super frustrating to see a lot of new investors get sucked into stuff like this, because I feel a lot of people who come to us, because option selling kind of tends to be the last stop for a lot of people as they cycle through different trading opportunities and different trading strategies. But people have definitely gotten burned from stuff like this before they arrive to what we're doing. And our goal is to try to reach as many people as we can so people can avoid falling for stuff like this. But, it is what it is. And you might be looking at this saying, how's anyone falling for this, right? If they got in at 1, they've still made money. The flip side is going to be GREE, where people got in. Chart's a little bit off because SPRT was the ticker on this prior. But SPRT, where if this thing loads, all right, it's not going to be loading for me. But if we pull GREE back up, essentially people were in at the equivalent of $80 a share and just got absolutely crushed as this thing fell back down. BBIG was another one, and actually another one of these fintwitt characters, not just Mr. Zach Morris here, but you've also got Real Will Mead is a guy that I've got some beef with. If I scroll down here and find some tweets that I called out from him. Let's see where I think I might have to look into my tweets and replies here. Some really good dead air right here for you guys as I just scroll down here. But here we go. Yeah, it was the same thing about SPRT. This is exactly what he was talking about. He tweets out, oh, SPRT, according to the short interest, this has to run at some point. And we called this out on September 10th because it was one of those things where it most definitely did not have to run. This guy is just tweeting this out because he 100% has some sort of stake in this stock and would benefit personally from it going up. And when we called that out, it went down. We called this out, September 10th at 9 in the morning. It dropped 20% that day. On September 14th, it dropped another 15%. And then after that, it was down even 40% on the day. And conveniently, this guy stops talking about it on September 14th after this big drop occurs. And what's more interesting about Will Mead, if you actually look into this, and I think this is something I'm going to make a video on, but he claims to be a former hedge fund manager educated at the University of Chicago. But what's interesting is if you type in Will Mead, and I'm going to use a little bit of a help here, but Goldman Sachs claims to have no record of this guy ever working for him. And it says former hedge fund manager, but in his Twitter bio, it used to say former Goldman Sachs, like PM or something like that. But basically, this guy is a fraud because he claimed to work at Goldman at one point. He does not. He used to try to pump crypto. If you could see when this article was dated back in 2020, he tried to pump out a bunch of crypto, and he's just not a legitimate person. He is a fake persona, claims to have some sort of huge finance background, but he has all these followers. He uses them to pump stocks, yada, yada, yada. Every now and then he tweets out some good info. I mean, you can't get that big of a following by having just all bad information, but the way that these guys participate and coordinate for these pumps is just really, really frustrating. It's a big reason why we try to create the platform that we have to try to get people steered away from that kind of activity. But let me avoid that tangent and get back to what we're trying to talk about on this stream tonight, which is what's going to be going on for the upcoming week in the market. So as always, we've got the trades that we roll over from week to week. ANY, we have 5 strike puts that are going to expire not this Friday, but this upcoming Friday, 10/15. And 10/15 is going to be a pretty big day for us because we have a lot of trades that are starting to line up to expire on 10/15. And to that point, 10/15 is the monthly option expiry. A lot of options that don't have weekly options, like if we take a look at ANY, there you go. You don't have weekly options here, but instead you have this monthly October 15th expiry. So typically when you see stuff like this and you're 4 or 5 weeks out, I like to stay away. However, I think it's a good idea in the 2 or 3 week window to expiry on these to start to get in. And that's exactly what we're in now for October 15th, right? We're 2 weeks away from expiry. So, as you could probably tell from my trading history, and for those of you who follow us decently, we like to open a lot of near-term expiry options because you maximize the rate of theta decay in the final week of expiry. And you just, in general, when you're running a wheel-type strategy, you get more flexibility about what strike you want to sell, if you want to take assignment, if you want to cut the trade loose, instead of waiting and having your money locked up like we do, unfortunately, with SPIR until November 19th. So, point being, we think now is a good window because it's a little bit more near term for these monthly expiry options. And a little bit interesting here is that the futures, the S&P 500 futures, are now down 0.22% after opening up around plus 0.2%. So it looks like we might give back a little bit more come tomorrow morning. But, we're still 12 hours away from the market opening. So pretty much a lot could happen between now and then. So I wouldn't put too much stake in that. But I think these are a really solid value here, right? You get a 4.71% return on risk, assuming that you sell these fully cash secured, which over a 2-week period is fantastic, right? We always want to target at max profit between about 1 or 3+% ROR a week. If we're going to get super risky, we'll go above 3. But in general, that 1-2% range per week is the wheelhouse, right? You get some really nice trades from an expected value perspective, and you get some decent cushions, and you get returns that still compound to really, really nice numbers. So that's what we try to target. And if you look, that 4.71, more of the same right there. ANY spiked up decently back on September 27th, and this is when we got in a little bit of an IV reversion type trade. But again, one of those, what do we know about a 5-strike put? As long as ANY finishes above 5 come October 15th, we're going to hit max profit on that, and that is this line right here. That is a price that it has not traded at in, if we zoom out a little bit, we'll definitely see it, but it hasn't been there since August 27th. Question in the chat from Anon in YouTube: is your goal to avoid holding stock and just sell puts? Yeah, in an ideal world, we never get assigned on our puts, right? We just keep taking profit week after week when we see it, Because in general, when we sell options, it's like selling insurance. Every now and then you're going to have one that moves a little bit too far based off how the options are priced. But in general, most of these are going to expire either worthless or for profit for us, and we're just playing the numbers game. So if we're in a situation like we talked about earlier with CRSP or CLOV, where we see profit early on in the week or at the end of the week at some point, and we move on to just doing the same thing again for the next week with a lower target. So ideally, we never get assigned, but sometimes, like with APT, if we could find when we sold APT puts, we sold 7.5 strike puts, and it went against us. So we had a little bit of a loss. So what we did is we took assignment of the shares, and that still moved against us. So we eventually took a loss. But beside the point, just taking assignment is another different way to play defense on a stock. There's a lot of different strategies to use when things move against you. Assignment is one of those, but in general, we like to choose trades with strikes where the things aren't going to go against us, but we know that the reality of trading is that sometimes they will. So it's going to happen, but the goal is to avoid holding stock. And another question, how many years or months did it take us to become consistently profitable? And to be honest, it's something that's always kind of been evolving. We have 2020 tracked in here. If you look at our 2020 tracker, we've been doing pretty well the entire time that we've been selling options. So we've got another question about KORE in the chat. I'm going to answer that in just a second. But we've done pretty well on a week-to-week basis. We had one other big, and this one coincidentally was a SPAC as well, where we learned a very big lesson about trading. But about trading things near the peak. But in general, we've been pretty consistently profitable. And I mean, even in spite of the fact that we lost $47,000 last October, and it's something that we're not going to hide because it's, again, important to be transparent about the outcomes that we've had in the market. But, despite that, we still made money, $20,000, even just in that 6th, 7th month period that we publicly tracked last year. So we could look back to last year and say, hey, we were pretty profitable. We could look to this year and say, we've been very consistently profitable. I think these monthly summary amounts look a lot better than the fluctuation that we have in these. So we've refined the strategy. I think we've found some more success in some different areas and have done a better job of that this year. But, I guess a high-level answer to that question is we haven't really ever lost money, me personally, selling options. It's been pretty smooth sailing with the exception of, when something like this happens, but you can't get too mad at that when you sum everything out. You've made a decent profit in the year overall in 2020, and we've kept up more of the same in 2021. So it's one of those things where selling options is like a glorified way of holding stock. You just choose different prices to purchase a stock at, which are at a discount from the market price. So in a literal sense, it's safer than straight up buying stocks. So that's what I really like about it. And two, you could still add that kind of trading aspect to it if you want to pick different stocks this week, different stocks that week. You want to choose what strike. Do you want to take assignment? Do you want to sell closer to the money? Do you want to sell further out of the money? So there still is a lot of subjective decisions you get to make as a trader, which you can get better at and improve at in practice. But even when things go against you, they still can't go that terribly, provided you're choosing relatively safe stocks, you're choosing relatively safe strike prices, and you're being smart about the amount of buying power that you have, right? Heading into this week, we have 41% of our buying power used. And you might say, okay, but you have 153% if you're fully cash secured. And that's something we're comfortable with because, UWMC, that's a really safe trade. That one's a couple months out. UWMC isn't going to move too far. This is another one that's decently far out of the money. And we could sell these and free that money up pretty much any time. So if we took those away, we're back down below 100%. So that's why we feel relatively safe with that 153 number, despite how big it is. Next question we've got here. KORE and how it might move next week. And then for those of you watching, if you have any stocks you want to take a peek at, feel free to type them in there and we will happily take a peek. But it looks like, correct me if I'm wrong here, this thing just started trading on Friday and it doesn't have any options. So one that we like to stay away from. And to be honest, it looks like an IPO. Yeah, it's a former SPAC. There you go. They closed a merger with Kerberos Telecom Acquisition Corp. And former SPAC, with what we've seen lately, I tend to just try and stay away from those. And especially straight up purchasing the stock is something that, funny enough, that's like a normal investing strategy. I just feel it's so risky to buy things at market price now when we know we can do, I feel it's risky to buy things at market price knowing what we can do with selling puts and how assignment of those typically works. So this one I would stay away from, and that's typically my advice for everything that has options. And to answer that other question about why we have things marked new here, it's because we opened these last week. We didn't put them on last week's tracker, but they're trades for this upcoming Friday, expiry, and that's why they're new, because they weren't on here last week. Let's see what else we got. PROG. Let's take a look at PROG. No idea what that is again. Oh boy. Well, I'll tell you what. This is at least a little bit interesting because we can see that the 1.5 strike puts, first off, we love to see 50-cent intervals on the strikes because that gives us some serious flexibility with options that we want to sell. So if we wanted to sell 1.5 strike puts for 25 cents, we know that we could, one, have the stock finish above $1.50 and we'll make a 22% return on risk in 2 weeks, which is enormous. Or two, we'll get assigned those shares with the $1.25 basis. Now, if I had to make a guess here, I think I would say that, the stock has traded well below 179 in the past, or two, that it's a healthcare stock with a big event coming up. So let's take a look at the chart and see if either of those are correct. And there you go. Just a few days ago, it was trading below $1 a piece. So even if you did want to go down to $1 and sell this for about 5 or 10 cents a piece, you can get a 95-cent or 90-cent basis in shares if assigned, which is right around here. Not terrible. But let's take a look. I'm kind of curious. Let's look a little bit further back, see where this thing's been. 86 cents seems like a decent base on the 1 month. If we go a little further out, 66 cents looks like, there's definitely a little ways to go. But in general, looking at this chart, it's at a decent entry from a 180-day perspective. Looks like someone named Zip Trader put a video out on it today. Might have to take a peek at that. Look at that as futures get a little bit lower, minus 0.35%. That's kind of interesting. But let's see what it is, because we don't really know what it is. What do we want to do when we don't know what a stock is? We go to the Analyze tab. We go to Fundamentals. We type in PROG, and this thing is going to tell us exactly what this is. There you go. It's healthcare. So the fact that there's so much volatility means they might have some sort of upcoming event. And NASCAR All Out, if you've seen that video and have some information you'd love to share, feel free, because I'm kind of driving blind right here, going through the news, trying to figure out what's going on. Looks like the stock has been circulated as a potential short squeeze candidate by this piece of news right here. Maybe, and this is one that's always a big red flag, right? The shares are trading higher on abnormally high volume, not seeing any company-specific news. So if we see spikes like this, but it's on good news, right? You could have the thesis that it used to be trading at 87 cents a piece. There was good news, so theoretically it should be worth more than 87 cents a piece, and that's when we'd be comfortable going in with something like a 1.5 strike put here. However, the fact that there's no associated company news means this might be pretty artificial of a jump. But if they don't have any upcoming, since it's a healthcare stock, if they don't have any upcoming trial results or anything like that, I wouldn't hate the idea of calling this a riskier play and just giving it a shot. Because worst case scenario, what, right? You've got shares at $1.25, whereas if you were an option buyer, worst case scenario, you lose your entire investment. With us, we just have a $1.25 basis. We wait until next month, and then you could sell calls for some insane premiums right now, which are a cent for cent reduction in your cost basis. So that's something that might not be the worst idea in the world either. I mean, you can go out to January here, and now this is interesting. If you want to sell, you could buy shares for about $1.70 right now. You could sell a 2-strike call in January for about 65 cents, meaning you could have a $1.05 basis with the potential to get it called away for $2 a share. So potential for a 100% return. But I'm always partial to the near term expiry. So what we would look at here is the 1.5 strike put. And now what's always interesting as well when we actually click on this to see what the trade would look like is if our broker gives us any benefit of the doubt on the margin here. So normally to sell 10 of these at a 1.5 strike, it would take about $1,500. And yeah, the broker requires all 1255 of that. So not too exciting right there from a margin perspective, but you don't need to worry too much about margin when the puts themselves are offering a 22.45% return on risk. And the way that this thing's been moving, another one of those trades where it's pretty much trader based, right? The reason you're seeing a big spike here is because you see a big spike in volume right here indicated by this blue bar. So if you're worried about the overall market like the S&P 500, which continues to dip as we speak, and you want some trades that are independent of the market, I think that's a great way to get a little bit of diversity in the trades that you're sitting in. So this wouldn't be the worst idea in the world, provided, again, caveating this with the disclaimer that I would only do this if I were confident that they don't have any upcoming trial data or something like that. Because if we love to talk about the market maker move that TD Ameritrade shows us right here, this indicates that in the next 2 weeks, the front expiry, October 15th, the way that the options are priced, their little proprietary formula that they have, indicates that this thing is going to move plus or minus $1.06, meaning this thing could go all the way up to 285, but could also go down to 73 cents, in which case a $1.25 basis wouldn't be the greatest thing in the world. You'd be sitting on a pretty decently sized loss there. So with that big of a move, when the implied move here is about 66% of the stock price, you've got to think that there's some sort of news coming up. So, a fun one to look at from the amount of return that you could potentially get, but would definitely do a little bit of research to see if there are any upcoming events on that. But let's get back to what we opened up at the end of last week and what we think is a good play to get into for this upcoming week. I think pretty much everything that we entered into at the beginning of last week is a decent trade to get into for this week at this point. So let's go through what we're looking at. This might be the only one where the train has kind of left the station a little bit. The PLTR, the Palantir 22 strike puts. If we take a look at Palantir, I think, let's see where these things are trading for. Yeah, these are already down to about 11 cents a piece. So we could put that in there as 11 cents because these are already down there. That's almost pretty much at 50% max profit. And you might say, hey, HT, earlier on in the stream, you said if something's at 50% of max profit, it's probably a good idea to close it out. I'm going to let this one ride because personally, I'm a decent believer in Palantir, and I'd be perfectly happy to take assignment of shares at a 22 strike basis with it currently trading at 24.33. Why do we say that? Because we open this up and see more red lines than like a bank vault in a movie. And 22 is right around here, which is if Palantir were to continue to keep falling from this level, you could potentially expect to see a little bit of support around here in the 21 to 22 range. So that's why I'd be perfectly happy taking assignment on it at that range. Next one, CRSP, is the one we talked about a little bit earlier because we closed that out last week and left a little bit of cash on the table to begin. But again, we moved the strike lower. We rolled the expiry out. We're going to remove that drawing, extend this one to the left. And now we have a very, very decent looking break-even price for the upcoming week or so, right? We have a price that not only is 5 or 6% below what it closed at, so as long as CRSP doesn't drop 6% next week, we're going to make money. But our break-even price also coincides with some levels where this wick down here gets around there. We see a little bit of chop in this area. And to that point, the strikes that we picked that have purpose, right? We picked 110 for this last week. And if you plot 110 right here, that's what you get. If you extend this to the left, you'll see it bounced off this, bounced off this, bounced off it, bounced off it, bounced off it. So 110 seemed like decent support. So we had reason to believe that if we did sell those 110 strike puts and it did get close, it would, at least in the short term, bounce off of it again. And that's exactly what we saw happen. So while we did want to ditch the trade, just in case it broke through and we didn't want to lose any money, picking strikes like that where you try to match up levels of support when you're selling your cash secured puts with the strike that you're selling it at is a really effective way to get some additional assurances that even if the price does start to test the strike you sold, that at least in the short term, the price is going to hold relatively steady around there and you could make some profit on that. But that's what we're doing with CRSP, Clove, 7.5 strike put, another one where anytime we see it get around this 7.5, 8 strike level, we're perfectly happy to get back in. These are the lines that we had from last week where we made 66% of our max profit on pretty much day 2 of the trade. Coming into this week, we've got this 7 strike here, which is our max profit point. We extend that one to the left and take another look at the 180 day like we previously did. You know, this thing hasn't touched $7 a share since back in May. So if it were to do that, one, it'd be a pretty big downward move. But two, if it did get down to this level, like we brought up with CRSP, it bounced off this 7 strike level back in March. It bounced off it again in the end of March, mid-April, happened again mid-April, and then chopped around this level back in May. So we have some decent confidence that if it does come all the way back down and hit 7 again, based off the previous support we've seen at that level, we can reasonably expect that it hangs out above 7, for at least the next 4 or 5 trading days. And again, that was when we were able to sell for 15 cents. We sold 15 of them. So if that trade thesis comes true, that's $225 for us right there. Like nothing ever happened, right? It takes 3 seconds to set that trade up. You just let it ride for the week. If it works, $225, go have yourself a good weekend. Wish, really similar one right here. Not that I think this is the greatest stock in the world. I just think the numbers look really nice at that 5 strike, right? Again, another one where we did this previously on the way down. And pretty much in the past, if we look at the past 20 days here, maybe the 180 days a better look. Ever since roughly August 10th, this thing basically has taken a straight line down. But despite that, we've made exclusively bullish trades on it, and we've made money on it, which just goes to highlight the amount of value you get when you identify decent premium opportunities on these cash secured puts. Because again, we're not like these people on Twitter where they're pumping these stocks and we needed to go up, 100, 200% to make our quota for the week. But we just needed to not completely shit the bed and we're going to make money. So to the point that Hypers put on the Twitch chat, so many people on Wall Street Bets and on social media are crying about Wish, because that was another name that was pumped by those stock pumpers on Twitter, are whining about losing money on the way down, whereas us, what I, maybe conceitedly call smarter option sellers, are sneaking in, collecting premium on the way down and making money while people are getting absolutely crushed by the drop. And to address that other question from Hypers in the Twitch chat, which I can pull up right here again, any value on having probability of touch on the options chain? And hey, how's it going, Green Machine Man 7? Thank you for joining us. But to that point about having probability of touch on the options chain, I don't think that one is terribly useful. But what I do think is useful, if you go into option theoreticals, is not the probability of touching, but the probability out the money. And what that means is, probability that it finishes for puts above this level or for calls below this level, which in plain English means you could take a look at this and see the probability that we hit max profit. So the probability that it finishes above 5 is 68.52%. We could round that up to 69%. Nice. And know that there's like 7 out of 10 times we're going to hit max profit on this Wish trade, which again, we sold 15 of these for 13 cents. That's $195 on a trade that took 5 seconds to set up. And all we do is just sit on our ass for the next 5 days and wait as that money presumably pours in. Or if it doesn't and Wish continues to drop, we get assigned. We have 1,500 shares with a basis of 487. And then we go from there and sell calls and continue to lower that basis. Whereas all the people who are waiting on a rebound get completely crushed as the premium decays and the stock continues to drop. But, RSI is one of our favorite indicators of, short-term bounces. Are we going to see a little bit of a rebound here? And this is getting into the blue, meaning it's oversold. It's below 30 on a 180-day basis. And when Wish has gotten into the blue like this, big green candle for a rebound, gets into the blue right here, we see a rebound, gets into the blue right here, short-term rebound before falling off again. And now it's kind of flirting with the blue. Could definitely go a little bit further, but again, we draw that line here at 5. We know that this is our max profit point, and then our break-even price below that at 487. And you can see these pairs of lines that we've drawn all the way down, right? We've pretty much been making money by setting our goal lower and lower and lower as time passes. And we're going to do that again for this upcoming week with these Wish 5-strike puts that are going to be expiring this Friday on October 8th. And again, just sit back, let wish play out as it may, if the people on Twitter and Wall Street Bets want to pump this thing back up, it could go to a 10 for all I care. They can make all the money in the world, but we're just happy that it finishes above 5, because if it drops another 30%, or excuse me, 30 cents, we're still going to hit max profit while those people are going to be upset and frustrated while this thing takes its path down below 5 a share. And then the last one that we entered into was Hyliion, which shout out to October of, maybe a little deja vu, and I shouldn't be doing this because in October we lost $47,000 off of this ticker, but it is October 2021. We're going to call this a new year. We're wiping the slate clean. We've made decent money on it this year off this stock, but getting in at an 8 strike, this is another heavily technical analysis driven trade right here. Every time this thing gets around 8, which pretty much finished dead on the number Friday before jumping up 5 to 10 cents after hours, but we've got this line drawn here at 8. Last time it got to 8 was August 20th, bounced off there pretty cleanly, bounced off there decently back in April, and bounced off there again right around May 15th. So this is one we think really decent value right around that 8 level, so we were happy to sell 8 strike puts. And again, we know that if we sell 8 strike puts for 22 cents of premium, what does that mean for our break-even price? It means our break-even price is going to be all the way down here at $7.78. And for those of you who are newer here following us, why did we lose so much money on Hyliion back in October in 2020? And why do I have the hiccups right now when I haven't really eaten anything? 2 great questions. I don't know the answer to the second one, but the answer to the first one is we basically got in up here on a former SPAC, which was trading around 10 a share, right? We see that typical SPAC chart. Got in around here. We quite frankly just bought into all the hype. I don't know why I did this, but the amount of money we lost from it ensured that I will never do that again. We lost a terrible amount of money, 47 grand in October. But again, sucks that it happens. But point one, transparency is super, super, super important, right? We started here with SHLL 48 strike puts, and SHLL was the name of the SPAC that became HYLN. So selling 48 strike puts, we quite literally got in right around here, which is basically the peak. Kind of embarrassing, but transparency is important. An expensive lesson that we learned, that we will never make the same mistake. And hopefully for those of you who follow us, we can impart those lessons upon you so that you do not make a similar mistake in the future. But getting in at an 8 strike right now is a hell of a lot better than the 48 strike we tried to get in at this time last year. So we're going to learn from that and move forward from there. A couple questions. We got one from C-Rob, which I assume it's C-Rob unless it's Crob. I've never heard of a Crob before in my life, in the YouTube chat, asking, do we sell more weekly or monthly options? And in general, if we have options that have weekly expiries, we're always going to sell that weekly expiry. Nearer term means that you get theta decay. The extrinsic value in that option is going to decay more rapidly than if you were to sell 2-3 weeks or a month out. But for stocks that we're in on right now, like ANY, they only have monthly expiries, so that's kind of the only option. If it's a good opportunity, it's a good opportunity. Don't stick your nose up to it just because there aren't weekly options. And the Mikkel FNM in the Twitch chat asking if do we use Trade Flash on Thinkorswim? And we do not. So, and quite honestly, I've never heard of Trade Flash, and there's so much stuff that Thinkorswim can do. I think some of the YouTube videos that I plan on creating in the future are honestly just going to dive a little bit further into how we can use some of the features in here, like this market maker move, to help us make decisions as option sellers. And one way that I can highlight really quickly right here is by comparing this market maker move to the implied volatility. So if you look at the implied volatility of the option chain right here, it's 175%, meaning that it implies a $1.60 move one way or the other, which is why the options are priced as such, right? However, this is TD Ameritrade's proprietary market maker move formula, which is used by market makers who are actually selling these options, and that implies that there's only a 95-cent move. So basically, the amount of premium in these implies there's a $1.60 move, but realistically, we think it will only move 95 cents. So that's an opportunity for an option seller because the implied move is likely greater than what the actual move will be, and that's why we're getting in on there. I just got a notification that someone followed us. I completely missed it, but thank you for the follow. I'll try to do better to call these out and squint and try to read on my little screen who's coming through. But appreciate you guys joining us tonight, new and returning viewers. But I think that pretty much rounds out what we got into for this upcoming week. And one point that I do want to make is the best way I think to evaluate what I have for the upcoming week is to ignore the monthly stuff, right? These are hopefully going to get decay at a consistent rate and have some profit going in the background to help rescue any trades that get into hot water on a weekly basis. But I think the best way to evaluate what we have is just to zero out these weekly trades that we have. So we talked about Palantir at 22, CRISPR at 104, Clover Health at 7, Wish at 5, Hyliion at 8. If all of those ideas come together and work out the way that we think they should, and again, they should, because if you take a look at probability out of the money, we're always going to be above 50% probability out of the money, right? That's not one of our weekly ones, but if we look at Palantir, there's an 86% chance that this thing hits max profit. If you take a look at CRSPR, how did I forget the ticker on this in 3 seconds? Brain fart. CRSP. If you look at CRSP, we have to go to all here to even get down to 104. There's an 82% chance that we hit max profit on these. So we have these really, really high percentage trades. Emily, welcome to the Twitch chat. I hope you enjoyed your dinner. And even if you missed most of it, but you could go back and watch the replay on our YouTube channel. So you never really miss all of it. But if you got any stocks you want us to take a look at, we are more than happy to do so with you joining us right now. But again, this is, I think, the best way to evaluate how we're set up on a week-to-week basis. The fact that, hey, if these weekly trades that we have set up right here, the thesis that we have set up there, they all stay above the strikes that we sold, which, again, they're likely to do so, we're in line to make $1,500, which is just under a 1% return. And I think that's a decent amount to start off with. So I'm going to undo all of this so I don't show profit that I don't have yet. But when you then combine that, actually to further this example here, combine that with the fact that this expires in 2 weeks, so maybe it'll lose half of its value in 1 week. Same with these right here. These potentially could go to 0.3. And if these start to decay the way that we expect that they would, this might drop down to 9. This might drop down to 0.6 this week. SPIR might drop off to 1.3. Obviously, these aren't all going to hit profit. But again, this is 2 weeks away. This might lose half of its value this week. But this is when these numbers, these base hits that we're collecting, and some of these, we might be collecting some doubles, some extra base hits. But, we're not trying to hit a grand slam or anything like that. But these build on one another. We get profit from trade after trade after trade. And individually, every single trade that we enter into has 60, 70, 80% chance of hitting these gains that we see right here. And even if we do have a couple losers along the way, the amount of winners that we have are going to overpower that. And in the long run, some weeks, it all does come together. We hit green on pretty much everything. But if we do have losers up here, the winners will take care of it. If we have losers in the middle somewhere, the winners take care of it. That's $3,000 of profit. There was $5,800 of profit that week. And if you have a couple really bad trades in a week, the winners will take care of that as well and lead you to more of a break-even performance as opposed to your portfolio nosediving. But again, if everything goes according to plan, which again, playing the numbers game here, it's supposed to, it's likely that they do, you start to build profit on one another. And if something like this happens, as terrible as last week was, and the fact that we blew pretty much $7,000 on 2 trades, we're going to be right back at an all-time high in our account. So we're really looking forward to this kind of a setup. Let me back all these out again. And another good question here, how much capital to start from KJ trades? So I quite honestly, obviously, being completely transparent, because we want every single trade we call out is in here, and we have all of our winners, all of our losers. We talk about the good, we talk about the bad. We do have $161,000 that we're trading with here. However, you can do this with as little as $1,000, $2,000. I think you could start up with. Obviously, you're not going to be able to be selling 50 or 100 or 40 or even 10 contracts of things off the bat. But with $1,000 or $2,000, you could definitely sell a couple contracts at a time, spread that out over maybe 2 or 3 different stocks, and start to get a general idea of what we're doing going. And from there, some solid personal finance habits can never be emphasized too much. Start to save, put some more money in that trading account week after week after week. I mean, we weren't, I'm not like a trust fund baby. We all started in generally the same place, right? I had $0 in my savings at one point. It just came from saving paycheck to paycheck, not living too expensively, being smart with my money, and now getting into a point where I'm making some serious returns on a dollar basis from week to week. And that's something that I've built up to. It's not something we're going to get overnight. And it's something I tried to chase overnight for far too long. And I lost money buying options and trying to basically play the lottery, effectively doing that. But that kind of patience is something that is super, super, super important. And making sure you stick to a good strategy like this. Don't chase the carrot in front of you. If you're seeing people on social media make 200 or 300% on options overnight, I guarantee you in the long run, they're not making anywhere near that much. People hide their losers. We've got everything laid out right here for you so you can get a general expectation of what things look like as you're moving through here. And the follow-up to that question was, what percent do we suggest deploying on the first trade? So to the extent you can afford to, I always like to start with about 6-7% fully cash secured at the beginning of my trades, with the exception of the safer ones right here like PLTR and CRSP, because I'm perfectly happy taking assignment of those. But for ones that are more so like trades with Clover, Wish, Hyliion, we like to start with about 6% of our account, because let me actually pull up the HT wheel diagram that we have. The strategy that we run is the HT wheel, and it essentially uses a little bit of a martingale type system, which means that we're doubling down sometimes to reduce our cost basis, but we have it pinned in here, I believe, somewhere. And there's Nation coming up big time for us, doing my work for me, right? Back in 2018, he got burned on CEI, saying in 2019 he would never touch CEI again. It went down to 9 cents a piece. There you go. I mean, he is, I don't like the guy. He's very misleading and is going to lose innocent people a lot of money. But to the point that I was talking about, as far as allocating percentages to my trades, this might be a little bit zoomed out and small on the screen, but the idea is, the trades go one of two ways, right? We put ourselves in positions where majority of the time we're going to make money. So 60, 70, 80% of the time we're going to make money here. We go back to the top. But what about that 20, 30, 40% of the time, the minority of the time? That's okay. It's going to happen, but that's when you take assignment and essentially double down. So if you start with a position that's about 6.5, 7%, when you double down, that's going to take you to about a 12% position, 12% of your account, that is. And that's, again, perfectly manageable, because you'll basically run it back the next week, put yourself in a position where 60, 70, 80% of the time you're going to hit this, and then 20, 30, 40% of the time you're going to roll over here and do it again. But again, this happens 30% of the time. This happens 30% of this 30%. So this really only happens maybe 10% of the time. And then from there, you do it again. And then you double down and go from 12 to about 24%, 25%. So I think 24, 25% allocation of a position in my portfolio is about as high as I would like to get for one that I'm running the wheel on. Now, some of these long dated puts are a little bit different as far as allocation is concerned. We could talk a little bit more about those another time. But for these week to week trades, that's how I like that allocation to line up, because then we've doubled down again and again. 30% of the time you're going to end up here, but again, it's 30% of the 30% of the 30%. So maybe 2, 3, 4% of the time you're getting down here. So 2, 3, 4 out of every 100 trades, you're ending up at one that takes up a fourth of your account. And then the others, the 95, 96, 97 instances, you've hit profit at some point along the way. And for those of you that are new, this might look like a difficult flow chart to follow, especially since it's probably very, very small on your screen and maybe a little bit blurry. But we have a 4-part video series on our YouTube channel explaining the HT wheel and how it works. So you could check that out for more information. As always, if you're in our Discord server, we are always happy to answer any questions. We always want it to be free to learn for everyone, and that these premium options we have right here, where we actually give trade alerts and talk about plans on our watch list and scanners, those cost a little bit extra money, less than $1 a day, and I think it's definitely worth it with the amount of returns that we've been getting. But the goal is in line with what I've been talking about with how I hate people on Twitter pumping things like that and leading innocent investors astray. Our goal here is to make it free for anyone who wants to learn the strategy. So we're never going to charge for our YouTube videos. We're never going to charge to answer your questions either in the Discord or on the stream. The premium stuff we offer is just in addition to that to help further boost your trading with our trade alerts, trade plans, watch lists, scanners, etc. So, that turned into some self-promo right there, but hopefully that answered the question about position sizing, why we do what we do, and why we like the way, that approach stacks up. Looks like Emily's saying Blue Apron is popping up a little bit. We could take a look. APRN to the late arrival on our stream. I hope dinner was worth it. But this is a little bit scary too, right? We talk about chasing stocks that have run up a bit. There's definitely some tangible downside to the $4.50, $5 area, but let's see how that translates to the put premiums. You could sell a 6-strike put, which will give you 390 ROR, which is really good for a 2-week trade. That's something that we like to take a peek at. But that would stick you selling a 6-strike put for a 20-cent basis would get you at about a 580 break-even price, which if you plotted that on the chart is right here. We always say that you don't need to have the same conclusion as us on every single trade. I think the only thing that's important that we agree on is that you take the option selling approach. Now, as far as how that is relevant to what we're looking at right here, if you're comfortable with that 580 basis, let this one rip, right? This kind of lines up with the peak over here back in June. Looks like it bottomed out around here before taking a big drop down back on May 5th. And even after the initial spike stopped at about this level, bounced off it before rocketing up to 8. We could see a little bit of support in this level as well. So if that's something you're comfortable with, absolutely let it rip. But as far as for myself and what I do with my trades, I like to think of, the absolute bottom as what is realistic for where the stock could go back down to. So a 580 basis on a stock that goes back down to 4 is really not something that I want to be chasing on the way down. But again, to the point I made at the top of talking about this setup right here, we don't have to agree on that. If you think 580 is a good one, absolutely let it rip, because that 3.9% return on risk fully cash secured is absolutely a great return for 2 weeks of your time. Let's see what else we got going in the chat here. Looking at the seasonal chart. Well, let's pull up the seasonal chart. You put the effort in to even link us to the chart, doing the work for us, even though the bot that we had in there kind of started bitching at you for putting links. We're going to have to disable him, because what can I do to this thing? I guess I could block it. I don't know. But let's take a look at the seasonal chart. Are we expecting 2 more weeks of market sell-off? And actually, my next video that I was planning, I started making tonight, and I'm going to be posting at some point this week, is about what we can expect from the S&P 500 moving forward. I'm basically going to be comparing the current pullback to recent pullbacks that we've seen in the last 3, 4, 5, maybe 10 years, and seeing if we had that similar pullback, by what date would SPX be a certain price, so we could compare those, overlay the charts, take a peek at those, and get an idea of if shit really did hit the fan for us in the upcoming months here, how bad things could get. Because again, every single trade that we enter into, we want to have our downside in mind. It's easy to make a couple $100 a trade over and over and over again, but the real skill in this comes in knowing what to do if things move against you and protecting your downside. But for the next couple weeks, right, do we expect any more of a sell-off? And I guess you're maybe assuming to what could be perceived as a little bit of a spike at the beginning of October before a drop-off and then, ripping into the holiday season. That's a good question. I mean, let's take a look at SPY. I think that's going to be the easiest way to look at the performance of the S&P 500. And I have it backed out a little bit to the 180-day, but it looks like we're in a decent downtrend. Let's get some drawing tools out here, right? Let's draw the peaks on. And I don't know if you could really, you could turn this into a trading channel, I believe. Redraws channel. And it looks like that kind of lines up. The peak and the bottom right there. So if we extend that to the left, it looks like we're definitely in a downtrend. That's not something it just looks like. But we at least have a couple points we could plot to say, hey, it's been bouncing off of these levels, right? And that kind of lines up here. But I'm not huge on TA, but this is looking all right. But could we get back up here before falling back down? I think absolutely. one of these things where I feel like every single week on the stream, we take a look at the 180-day chart and say, hey, this seemed like a big drop. But if you look at something in the context of like 3 years, this really isn't much at all. I think the last decent pullback that was non-COVID that we had was back at the end of 2018 that I remember. And that is when we see, there we go, the 5-year chart's working. It wasn't earlier when I tried to use it. But that was when we saw SPY go from about 290 down to 230. And that was from a time period of the end of September to roughly Christmas time before bouncing back up for the new year. And again, it's one of those things where even when the market does pull back, it only took until April of that year to get back to where it was before and make a new all-time high. So even if things get bad, no need to worry too much. But in the scope of what we're looking at right now, there's definitely a long way down to go if we had a comparable drop to what we saw back around here. So I would remain careful, especially when you look at like the 10-year or something like that, and it won't, for whatever reason, it won't go further back than 10 years. Oh, I guess it can. I just have to scroll. Anyways, point being, it could definitely drop a lot further back. And with the basically straight line that we've seen over the past, I guess it's not so much of a straight line anymore after how much it's run up lately. But, it was trading a year ago today back at around $340. So that's roughly a 30% increase in a year, where the S&P 500 yearly average is 9 or 10%. So you make of that as you please. If it went up the normal 10%, we'd add 34 to that. It'd be at 378. It'd be right around this level if it went up the normal amount. So I think there's definitely some room for a pullback. I don't think it's going to get all the way back down here, but I wouldn't be surprised if we kept moving below 420 and kept going further down that direction. But at the same time, to give you a little bit of a non-answer here, we never try to time the market, right? I think the way that we be cautious is not by taking all of our money off the table, but by just taking some of it off the table, getting into some trades that aren't necessarily correlated with the overall market. So if things start dying, at least a few of our trades are still going to be in play. And that kind of burned us a little bit because the idea with LIDR and SPIR were that they were going to be independent of the market. But, it is what it is. There's give and take on both sides of that equation. Just be sure to diversify not only by stock, but two, by strategy, meaning between things like IV reversion, earnings trades, condors, the wheel, diversifying in that way. And also diversifying the amount of buying power you're using, right? So foot off the gas off the bat, scaling in like we talked about, 6, doubling to 12, doubling to 24, 25. So you have about a quarter of your account in something in the worst case scenario, which should only happen about 4 or 5 times out of every 100 trades, but it's something that will happen. But that is the way to approach it. And this is what we've got set up. And looking at how many trades we normally have on a week-to-week basis, this is typically how things look going in. We like to have a few trades set up. So if these things all hit max profit, the market runs away. We hit that profit that we were looking at off the bat. But as you'll notice by the amount of new tags that we have on here compared to how many we'll typically have in a week, there are a ton of trades we make on a day-to-day basis as we react to the market and try to take advantage of what the market gives us. And that's where being in that Discord server, having access to those trade alerts is super, super, super important. So again, if you want to sign up for those 1 week free trial, or you can get a month free using our Webull referral sign up link that you could have right here in our Discord server. But to get access to all these, again, hourglass-trader.com. And you could sign up for HT Premium, and then you'll get alerted to all these trades as we make them. So you could emulate what we do. And we have these percentages out here as well, so you could allocate them accordingly to your portfolio size. But, that was our recap of last week. It didn't go great, obviously. We outperformed, so I can't be too mad at the end of the day. We wrapped up September with the $5,600 gain, which, again, I could never be mad at. And hopefully we can keep our streak going in October of not losing money a single month on the year so far. I think if we accomplish that goal, you will talk to me 4 weeks from now, and I'll be happy with that. I'm happy with how we are set up for the upcoming week. I think we have a good amount of buying power. We're only using about 41.5% as we head into the upcoming week. So a lot of flexibility. We're going to be able to react to the market if there are some things happening. With how volatile things have been lately, I definitely expect some things to be happening and there to be some decent entry opportunities for us this upcoming week. But as far as our outlook for the upcoming week, I think that's all we've got. I covered pretty much everything that I wanted to. We'll probably talk a little bit about earnings in our Discord server as those come up this week. I'm going to be making that video and releasing it about historical S&P 500 pullbacks and what we could expect if the current pullback were to match any of the prior ones. So stay on the lookout for that. That should be a really good piece as you think about risk management when you enter into different trades. But that is all we've gotten. I think when I signed off last week, I forgot to say, I hope I see you next week with more money than we saw you with when we talked tonight. So I think that might have been what caused the bad luck. So I'm going to get the sign off right here. I definitely got to have the cheesy little sign off. I'm going to say thank you for watching. This has been the Hourglass Trader, where as time passes, we make money. But most importantly, hope to see you guys, new and returning viewers, next week with more money than you had right now. So thank you to all of you who tuned in on this Sunday night. If you tune in for the back half of it, the replay is going to be available on our YouTube channel. If you're not in our Discord, go join that. I think the link to find that can be found in any of our YouTube video descriptions. So feel free to come join us in there. Thank you guys for watching, and we will talk again